Welcome to the Investors Trading Academy event of the week. Each week our staff of analysts and educators tries to provide you a better understanding of a major market event scheduled during the next week. This week we will focus on the Reserve Bank of New Zealand. This event takes place 8 times a year, usually in January, March, April, June, July, September, October, and December. The Reserve Bank is usually referred to as the RBNZ and is headed by the governor of the bank, who is at present Graham Wheeler, who determines monetary policy. The Reserve Bank uses monetary policy to control inflation and keep it within a specific target band. Monetary policy is encountered by ordinary New Zealanders in several ways. New Zealanders directly encounter the main instrument of monetary policy, the official cash rate, OCR, when they borrow money at retail interest rates through mortgages, credit cards, or personal loans, or when they save money in bank accounts that earn interest. Retail rates of interests are directly related to the OCR set by the Reserve Bank. The Reserve Bank was given statutory authority to control inflation provided for in Section 8 of the Reserve Bank of New Zealand Act 1989. The specifics were set out in a contract between the Governor of the Reserve Bank and the Minister of Finance signed in 1990. This policy targets agreement initially called for a reduction of inflation to a 0.2% increase in the CPI by 1992. This arrangement was unique at the time, although it has since been adopted elsewhere. The target was publicly viewed with skepticism at the time, but in fact the bank reached it ahead of schedule. The OCR can also influence inflation via its effect on the exchange rate. As discussed above, an increase in the OCR tends to push New Zealand's exchange rate higher. An increase in New Zealand's exchange rate reduces the New Zealand dollar price of imports, thus putting downward pressure on inflation. Trading partner inflation also has an impact on New Zealand inflation pressures. New Zealand imports a range of goods, and the price we pay for these imports depends on the price for these goods in their country of origin. Recently, the bank raised their key lending rate to 3% to try to slow down the booming housing market and to stop a balloon from forming and pushing up inflation. In New Zealand, the bank governor has broad powers to make decisions independently, whereas most of the central banks require a vote of members that form the board of the bank. New Zealand, being a small economy, allows the governor broad discretion to do what is best.